So we move to our final chapter, Interpretation of Financial Statements, Chapter 18. This is important for two separate reasons. The first reason really is, obviously, it's a priority chapter for us. I would put it in the top half of the 18 chapters in terms of what we can expect in the big exam. It's an important area for any student of financial accounting or indeed financial statements. I think the other side, possibly less obscure, is the practical nature of this chapter. I mean, certainly in my experience, understanding how to analyze or interpret a set of accounts is pretty important for a finance person. So really, this underpins, to some extent, an aspect that could be involved quite considerably in your career. So it's a very, very good idea to get a fix on this. Some people find it difficult, even finance experts find it difficult to properly interpret a set of accounts, and it is complex in places, but just having a feel for what I call the big numbers or the big ratios is important. A good feel for them, and then use that as the foundation. So let's take a look at the first area, interpretation and analysis of financial statements. What do we mean by that, or what do we mean by the process? Well, it involves identifying users, obviously. In other words, who's interested in your interpretation or indeed your analysis, or you are analyzing on your own behalf. Obviously, it involves in examining many aspects of financial information. That may well be a statement of financial position or a statement of profit and loss account and other comprehensive income, but it could be other financial information. And certainly if you can analyze or interpret those first two, using and analyzing, interpreting other areas, any financial information that you're given becomes a lot easier. In terms of analyzing, what do we mean? Well, certainly comparing on a simple level, let's say 1 year with the following year for a single entity company. Evaluating, what do we mean by that? Well, sort of looking at the upsides and downsides, or perhaps the sort of pros and cons in terms of this set of financial accounts, and coming to conclusion. And possibly then prediction. In other words, given the trend, given what we see over the last few years, what's our forecast? How do we think this company will do? And then I guess the final point is reporting in some way, to provide information in a format that's reasonable, understandable. And I'm talking about reporting, broadly speaking, outside of a given published set of accounts. So when we say analysis, when we say interpretation, we're not simply saying, let's look at the P&L and balance sheet and just talk over it. We're talking about providing users with useful information in a relevant format. Outside of that, in terms of users, well, we've talked about them. There's a variety of different users, internal, e.g., let's say, management, or indeed the directors. They'll sort of use a variety of different things, but certainly management information produced very regularly, periodically, weekly, monthly, etc. Management accounts is a good example, budgets, etc. They'll also use, obviously, financial information on an annual basis, as will external users. Certainly a prospective shareholder, or even an existing shareholder, is not going to be overly interested, let's say, in an internal budget, week to week, month to month. But they will be interested in profitability ratios, gearing, i.e. debt. They will be interested in the growth of net assets, etc., etc. So really, different users have different requirements, and understanding those requirements is important. Outside of that, when we think of ratio analysis in its purest form, what do we mean? Well, let's do some definitions first. A ratio, basically some sort of relationship between two numbers. So for argument's sake, let's say the gross profit ratio or gross profit margin is the relationship between revenue and sales, and indeed the gross profit. So that's an important one, because clearly we get a feel for what it costs us in percentage terms to produce, let's say, a product, and what the profit on top of that is. When we think about ratio analysis as such, we're talking about comparisons, or indeed meaningful comparisons between numbers, and indeed interpreting those comparisons. So again, using the gross profit example, has gross profit margin fallen dramatically year on year? Or has it increased dramatically year on year? There must be a reason for these things, given the fact that we know financial statements or financial accounts are sort of hinged on accounting policies and conventions. So if there is a big shift in one or other area, then we'd certainly like to know what it is. In terms of the purpose, really, I guess what we're talking about is, firstly, sort of areas, as I've just mentioned, for further investigation. Perhaps something has increased dramatically or dropped dramatically. And indeed, linked into that, clearly, trend analysis. One simple way of looking at a company and measuring its success is to look at perhaps increased percentage in revenues year on year, or indeed perhaps fall in revenues. Trends give you an idea behind the numbers. It's not perfect, but they give you an idea. Outside of that, certainly one purpose is to summarize information. We know that from a given set of accounts, statement of financial position, statement of profit and loss, and other comprehensive information, there's a lot of numbers there. There's a lot of information. And summarizing that information, particularly if we're looking at several years, is important and makes things a lot easier. Some information may not be relevant at a top end level. So for example, the amount spent on stationery, which is broadly stable year on year, is not overly important to prospective investors. So summarizing information is certainly one part of the key here to ratio analysis and understanding ratio analysis. In terms of the sort of comparisons, clearly with ratio analysis, in the main, we're looking at historical comparisons because we're looking at published financial statements or published financial accounts. We're looking at what happened last year compared to, let's say, what happened the year before. But in addition to that, obviously, we can use ratio analysis to roll forward. We can compare, for example, budgeted figures with actual figures and decipher a difference between the two and investigate that further. Okay? And breaking it down into classifications. Now, this is quite important, and I would say if you go online and sort of Google this area or do your research, you'll see terminology differing from place to place and indeed from jurisdiction to jurisdiction. A simple example would be, let's say, terminology used in the US, in the States, compared to, say, terminology used in the UK. But at the end of the day, for me, certainly there's four main areas when you look at key ratios. There's four areas of importance: profitability, liquidity, efficiency, and position. Now, as mentioned, the terminology may differ. For our FA course, let's take it on what the ACCA have included within the study hub. And under each of these banners or heads, if you will, we'll see a variety of different ratios. Now, for me, the areas that are included under these heads or banners are certainly important for you. Do we need to be an expert on ratio analysis to do the OT questions? I don't think so. Do we need definitely to have memorized all of these formulas? Yes, we do. We certainly do, because the questions in the main FA OT questions will focus on, can you calculate the ratio quickly or can't you? And for the most part, they're fairly straightforward. For example, if we look at gross profit, as just mentioned up top, basically revenue and indeed gross profit, fairly easy to find within a set of accounts. So we're going to put gross profit over revenue and divide or multiply by 100%. Net profit the same, net profit over revenue. So many of the formulas that we'll see here, not all, but many of them are very, very straightforward. So really, we've got no excuse for not memorizing them in the first instance. So I would take, if you haven't already, and I'm hoping obviously that you've read the study text carefully before watching this video, just take a quick look again and see how many ratios out of the ones that are listed here that you could take a stab at. But certainly over and above some light memory learning, we'll learn the ratios by doing the questions and by getting the questions wrong. So in terms of profitability, we'll deal with the calculations here a little bit more detail later on in this particular mind map. Liquidity, what are we talking about? Well, broadly speaking, we're talking about cash. When we think of liquidity, we're thinking of a business's ability to pay its short-term obligations. So broadly speaking, liquidity is about comparing current assets to current liabilities and showing whether or not a company has the capacity to pay the debts as they fall due. We know that the word current means 12 months or less. So this is an important area, and you've heard me in other areas of the course, not least the cash flow statements chapter, talking about the fact that for some businesses, some would say for all businesses, cash is king. Controlling your cash, knowing that you can pay your debts next week, next month, or in 3 months' time is very, very important. Efficiency, quite a few here. One or two are tricky to calculate or understand, for example, asset turnover, but certainly the receivable days and the working capital cycle, they're not overly complex at all and fairly easy to explain. We'll see them in a moment. Last one, position. This is sometimes referred to as debt or indeed possibly gearing as a head. But in essence, what we're talking about here is the risk inherent in business. In other words, the amount of debt that the business has in comparison to equity. Now, we'll remember from our earlier studies in the capital structure chapter that really a business has a choice as to how it's financed. It can finance itself through equity, just issue shares to the public, possibly via a listed company, and or possibly take on some debt, a bank loan, for example. So what this position area sort of focuses in on is the degree of debt and indeed the degree of equity and indeed the risk associated with that. Most observers would say the higher debt that a business has, the higher gearing ratio, as an example, which is simply calculated as debt divided by equity, the more you should be slightly concerned about that company. But many companies have high gearing ratios, e.g. manufacturing companies, because they're very much asset-based, and they'll certainly finance those assets in part with debt. So those are the four heads. More of those in a moment as we roll through this particular mind map. Now, moving from there to the first area, profitability ratios. Well, what do we mean? Well, we know we're talking about a comparison between income and indeed expenses. And we know certainly that when we think about a profit and loss account, that really there are several different forms of expenses. So leaving aside revenue for the moment, we know that for a standard company, it may well have cost of goods sold. So it may well have expenses that are directly related to the sale, the cost of selling one product. Outside of that, it will have indirect expenses. So percentages below the line, stationary motor expenses, salaries and wages, electricity, etc., etc. So profitability ratios all center on that relationship between the income or the revenue and those expenses. Indeed, the second point is relevant. We can indicate or we can gauge really how well a business controls its expenses or costs by using these ratios, whether or not that's ratios that are relevant, e.g. gross profit margin to cost of goods sold, or ratios that are relevant, let's say, to net profit or net profit margin, i.e. administration expenses, etc. So in terms of the profitability ratios, really two main areas out of what I've just said. We've got the sort of general profitability, which is what I've focused in on so far. So we're really talking about the P&L, and we're saying, okay, well, what's your gross profit margin? Out of every sale that you make, what's the gross profit that you make in that $1? Or perhaps net profit margin, easily found down at the bottom of the P&L. What's the net profit within each of those sales? In other words, what's your relationship between sales and indirect expenses? In terms of overall profitability, really, these areas are also important, and I would guess the big one for us is ROCE, or return on capital employed. And really what we're talking about there is profit before interest and tax, as a function of the capital that you employ in the business. In other words, the money and resources that you use to drive your business and to make profits. So there's an element of efficiency there, particularly when you compare year on year. Asset turnover is an unusual one and often examines some of the trickier questions within the OT section for this particular chapter are in this area of asset turnover. More of that later. Outside of that, return on equity. Notice the difference between return on capital employed, which is really a broad measure, i.e. total capital employed, and then return on equity. In other words, return on the equity that is owned by the owners of this business. We're assuming a limited company here, either public or indeed private. But equity is all about the shareholding, the return to shareholders or what they own in the business. Now, moving to the calculations, gross profit margin, as I've just mentioned, pretty simple. Gross profit divided by revenue times 100%. Not difficult to do. Now, I guess unfortunately in the FA exam OT questions, it's unlikely that we'll get marks or full marks just for doing a calculation just like that. But we've got to know the formula. What do we think about comparisons in this area? So let's say we have a decline. We've calculated the ratio and then year on year we look and there's a decline. Well, clearly, and let's be careful about the reasons here, because the OT questions do focus in on reasons, not just the calculation, certainly with this ratio. So certainly, if we have a decline, let's say year on year, quarter on quarter, certainly a fall in selling price has to be relevant. It has to be, because at the end of the day, the ratio is clearly gross profit versus revenue. If we reduce selling prices, we're reducing part of that fraction, and therefore we must say that that is in play. If we sell it less, then certainly gross profit has to fall, for sure. It may well be that revenue increases, but unfortunately the margin is the margin. What about change in sales mix? Now, we're simply talking about the range of, let's say, products or goods that we sell. It may well be that certain products, product D as opposed to product C, is selling more this year and product D has a lower profit margin. That would affect overall gross profit percentage. Third one down, increase in purchase costs. Clearly, that has to be relevant because, again, with the ratio, we're comparing gross profit with revenue. The gross profit is a function of purchase costs. If purchase costs go up, then certainly the overall gross profit margin must come down. What about increase in production costs? Same thing. Let's say we've got a manufacturing company and indeed our cost of raw materials, or let's say the mechanisms that we use to produce or to manufacture a particular product, prices increase. Clearly, that's going to have a downward effect on this margin and indeed on gross profit. Okay. In terms of increase, again, some logic here, sort of the reverse in one sense. An increase in selling price with no other, let's say, increases in purchase costs will result in the margin increasing for sure. Same thing with a decrease in costs. Third one's interesting, and we know from our cost of goods sold calculation, i.e. opening inventory plus purchases minus closing inventory, we know that changes, or indeed understatements, let's say, for whatever reason, in these areas is certainly going to possibly lead to an increase depending upon the way that things go. Okay, so let's look at the reasons behind the ratio as well as the calculation itself. What about operating or net profit margin? Really, overall profitability. We know that net profit's right down at the bottom, so there we have it after all expenses have been deducted. And indeed, we would suggest, and I've seen questions on this, so be careful, where you have, let's say, an improvement in gross profit margin, normally, without any other information, you would probably expect an improvement of the same sort of line with net profit margin. If there isn't, then obviously there's another reason. So let's say that we have an improvement in gross profit margin and there's very little improvement in net profit margin. Why would that be? Well, it must be a lack of control over indirect expenses, e.g. stationary, motor expenses, etc., etc. So watch for the underlying meaning behind falls and rises as well as the calculation. Return on capital employed, you saw that we sort of pigeonhole this in a slightly different way because we're talking about really, really high-end stuff here rather than the nitty-gritty of the P&L. So we're really talking about, efficiency and effectiveness in terms of available resources, or if you will, capital employed. We're looking at how a business uses the capital it has employed in that business. And if we've got, falls or low sort of growth, then certainly we know that we have inefficiency. Yeah. And now it says that management will need to investigate further, obviously increase operating profit, maybe sell some assets. I mean, there could be a number of reasons behind a fall or a low ROCE. These are just one. And I think, again, understanding the calculation, as we saw just here in terms of our options. For me, I think that the sort of first area, i.e. the first option, is probably the easiest one, where we say that really we're talking about capital employed being total assets less current liabilities. I think that's the easiest one to calculate, but it's up to you. We can do it one of either of these ways. Okay. Now, just going back to here, bear with me 1 second, just moved on a little bit too much. Just on this final point, again, the reasoning behind falls and rises, where you see questions in the OT section of the course, dwell on them, slow down a bit, because I would say that they are, 50% as likely to come up, possibly more. The examiner wants, some higher level knowledge, higher level technical expertise. Just being able to calculate it, for me, isn't good enough in this exam. So that's my warning to you, if you will. I hope you don't mind. Asset turnover. Now this is an unusual one because it sort of links the profit and loss account with the balance sheet, doesn't it? Because it basically says, well, revenue divided by capital employed. So what do we think in terms of a definition of it? Well, basically, the number of times the carrying amount of assets is turned into generating revenue. So in essence, as we saw, it's very much efficiency in one sense, although it's not under the efficiency banner. We'd be very keen to know how efficient a business is relative to its turnover. Okay. Outside of that, using, if you will, if you don't want to talk about assets, using its capital to generate sales. Okay, so quite a high-end and slightly complex ratio to understand for me. Return on equity, a little bit easier. As you can see here, note, it's unlike ROCE, profit after interest and tax. Ordinary share capital and reserves on the bottom. Now, why is this an important one? Well, certainly we're looking for a return on equity for equity holders. They're the owners of this business. Do note, as I've just said, after interest and tax, not before, unlike ROCE. Why the difference? Well, in essence, equity holders, and certainly prospective equity holders, want to know what profit is available after everyone, including any loan players, i.e. bank, and indeed the government, i.e. tax, have been paid off. That's why it's after. It's more relevant, as you see here, to existing or prospective shareholders than ROCE. ROCE is about capital employed in its entirety, everything. Have you used loans? Have you used equity? It doesn't matter for capital employed. Okay? Now, in terms of liquidity, I've said, and I've referenced cash here, we're talking about short-term liquidity ratios dealing with financial stability. Okay? Now, when we say financial stability, we're really talking about the availability of resources to pay short-term liabilities. And that is why there's a focus here on current assets versus current liabilities. Now, in terms of the current ratio, i.e. the first one, you see the calculation is very simple. All current assets divided by all current liabilities at a period end, normally a year. And as I've said before, we're talking about the ability to meet short-term liabilities without to borrow, without having to go to, let's say, long-term liabilities. So very, very important to us. Now note that when we look at the flip side, i.e. the quick ratio, it's basically exactly the same. The only difference between the two is inventory. Okay? Now you'll ask yourself, why is inventory excluded in this quick ratio? Well, let's think about it. It's the least liquid. If you look at standard current assets, you'll see, bank obviously, you'll see accounts receivable, you'll see prepayments, you'll see other debtors, you'll also see inventories. And in one sense, inventories right at the top are always at the top because they are the least liquid. And you'll notice that current assets, as they flow down, always get more and more liquid towards the most liquid, i.e. bank and cash. So the reason that the quick ratio stands apart is it puts a company in a position where it sees or takes out the reliance on inventories, which may take a long time to liquidize. They may take a long time, for example, to turn into a product. It could be inventories of raw materials. It could be inventories of partly finished goods, work in progress, etc. So that is why we have the quick ratio. And in terms of a broad rule of thumb in this area of liquidity, in an ideal situation, you're probably looking at 2 to 1. So you want your sort of your current assets to be roughly twice the size. Now that's a broad assumption, but certainly if you're in a position looking at a business where, let's say, the current ratio or even the quick ratio both are less than 1, then you would probably be worried, because your ability to meet and to cater for short-term liabilities, i.e. current liabilities, is lessened, because you're talking about current liabilities being more than your current assets, or more than your current assets less inventory. So liquidity is important. Remember, cash is king for businesses. Now, this is a sort of a standalone area, window dressing, and note it likens it to a type of creative accounting. Those can be used interchangeably if you look online, but window dressing is just that. It's the idea of dressing the window, dressing the accounts. So perhaps using creative techniques. Now, we're not talking about doing anything illegal here. We're not saying fix the revenue or fix the gross profit. We're really saying the use of accounting techniques. So for example, depreciation. You might choose a higher depreciation rate than me because perhaps I would show a higher profit, etc., etc. So, things have to be within the bounds of law, but at the end of the day, some elements of accounting are subjective and it's based on your view. Outside of depreciation, perhaps the amount of a provision, the amount of an estimate. So window dressing does happen, for sure. Next area for us is the efficiency and working capital ratios. Now, we saw from the summary there, we're talking about how well a company manages, let's say, its assets and liabilities, or certain of them. First one, inventory turnover. Now we know that inventory turnover is important to a business because some businesses can have very, very high levels of inventory. Same with accounts receivable. In other words, the collection period. Same with accounts payable. If we have rising receivable collection periods year on year or quarter on quarter, we know that our accounts receivable is rising. So therefore there may be a problem with credit control. In the same way with accounts payable, if we see payable days rising, is it because we've got less cash? We're not paying our trade creditors or accounts payable within the correct periods? That's a warning sign. Now, in terms of inventory turnover calculation, pretty simple. Just inventories divided by cost of sales times 365. And we'd really be looking to compare that figure, let's say on an annual basis, with perhaps the figure in the previous year and wondering, is there a difference? And if so, why is there a difference? We're talking about really the average time a company holds unsold goods. When we're talking about unsold goods, we're talking about the value of inventory. Why is it that that's increased dramatically year on year? There has to be a reason. So, for example, a high inventory turnover generally indicates, note, a efficiency in selling goods quickly. If declining, less quickly. So why is that? Or how do we know, or do we know why we're selling more quickly? What's the reasons for that? In terms of negative reasons, possibly a fall in demand for goods, or maybe inadequate or poor inventory control. Outside of that, maybe excessive stocks. Why are we holding stocks that are outside our immediate requirement? Maybe through discounts, maybe we bought too much. Or possibly, let's say we've got a lot of stock that's obsolete. It should be written off. In terms of positive reasons, well, as I've just touched on, maybe we're carrying a high inventory because we've bulk buyed. We bought a lot to avail of trade discounts. Maybe we're worried about stock outs, i.e. the idea that we can't cope with demand because we're low on stock, so we've bought more than we think that we'll need. Okay, so again, as I said over the other side of the mind map, let's always look for reasons behind everything, not just the calculation. Accounts receivable days, quite straightforward. Average time it takes to receive payment from credit customers. Now, again, the formula, very straightforward. What are the trade receivables or the accounts receivables? Divide by credit sales, again, times 365. So, when we compare year on year, if this is rising considerably, that's got to be an issue, because it simply means that, let's say weak credit control, people not paying quickly enough or paying within their terms. Maybe it's been deliberate. Maybe we've extended days for customers from 13 to, or from 15 to say 30. Or maybe there are customers that have slightly different terms. Maybe we have large customers that we've decided to allow 60 days because we know that if we allow them more credit, maybe they'll buy more. So again, we're always looking for the angle inside the change in the ratio. Accounts payable days, similar, but in reverse. We're talking about days representing the time it takes to pay for supplies received on credit. Now again, just the closing trade payables figure divided by cost of sales. Now again, there has to be reasons for changes in this period on period or period on year. So let's just say that we had an increasing ratio. Maybe we've got liquidity problems, because if the ratio is increasing, it must mean we're paying suppliers more slowly. Going to get a reputation for that. Or maybe, really bad news, suppliers may withdraw supplies. If we stop paying within terms, they could withdraw, cut us off. Outside of that, maybe we're not taking advantage of cash tickets like we had for other reasons, i.e. we're not as liquid. So, we're drawing on credit more than we used to. Next area for us is linked to the ones above, the operating working capital cycle. And in essence, we're talking about the full amount of time of converting resources, generally inventory, into cash. So in essence, a little bit of a loop, really. And you'll see that evidenced by the formula itself. We see here that any business's working capital cycle is going to be the inventory days plus the accounts receivable days less the accounts payable days. Now, when you think about that logically, that would give us the working cycle, wouldn't it? Because that basically means the amount of time that we're converting stuff or work in progress, raw materials, finished goods, etc., plus our debtors, accounts receivable, minus the accounts payable days, the amount of time that it takes us to pay off suppliers, into one set of days, the working capital cycle. Next area for us is position. So we've been through the first four. We saw some formulas that are, in the main, reasonably easy to calculate. One or two a little bit tricky. Got to memorize them all regardless. Position ratios, as I've said, are really about debt. So we're really focused here on how a company is financed, and indeed whether or not the current financing mix may cause problems over the longer term. And this would normally be a reference to the amount of debt, therefore the amount of risk. The two key ratios are really gearing, sometimes referred to as leveraged, and that essentially means the relationship between borrowed funds, i.e. loans from the bank, loans from VC, and equity capital. And that certainly relates to financial risk. The more debt we have, the more risk we are as a proposition. Now, in terms of the calculation, let me just go back a moment. My preference, just so that you know, in terms of the calculation here, we can do either one. My preference here is really debt over equity because it's simple enough. We don't have to involve capital employed, and it's easier to find, I think, within a statement of financial position. So this would be the one I'd go for. It's up to you. Going back to the plot in terms of detail, what is represented by this ratio? Well, it's several things. The first one, obviously, the amount of debt. But what we should know is, for some companies, debt is attractive in one way because it's certainly cheaper than equity. Why? Because interest, you'll note, is tax deductible and dividends are not. If you look at a statement of profit and loss account, you'll see an interest expense. What you won't see is a dividend expense, because a dividend is an expense. It's the distribution after all other expenses and indeed interest and tax. Outside of that, certainly, as I've mentioned, debt finance increases risk to shareholders, absolutely, because debt holders, banks, VC companies, etc., they have preference over equity holders in the case of anything going wrong, a wind-up, for example, liquidation. So there are pluses and minuses to both sides, but also don't forget, it's not unusual for certain companies, e.g. manufacturing companies, to have a high level of gearing because they borrow to invest in equipment. Now, in terms of interest cover, the second area, again, fairly straightforward. The calculation, the profit before interest and tax, coverage of the interest charge. So in essence, what we're saying here is, the ability to pay interest on outstanding debt from profits generated in the period. So really, you're talking about, and that's why it's called interest cover, you're talking about how many times the profit before interest that covers the interest. So let's just say you saw a company, you did the calculation, and the interest cover was 10 to 1. You'd be much more happy than if you saw another company with the interest cover being 2 to 1, because you can see, all else remaining equal, that the first company, i.e. 10 to 1, has much more coverage over interest costs. If profitability were to be affected in some way, shape, or form, it would need to be affected significantly for this company to be having a problem to pay its interest. Okay? So this is an important second ratio in this position area. Another sort of add-on area, not linked to position ratios as such for me, overtrading. Just a concept, a little bit like window dressing in the sense of it being standalone. Overtrading, and I've seen this in practice, you've got a successful business, growing rapidly, but it doesn't have long-term capital, doesn't have long-term finance. It hasn't organized itself to deal with such a rapid hike in trade. It's been so successful, and indeed you'll see the symptoms here. Great sales, inventories, receivables and payables increasing, not necessarily all good, because perhaps we're not getting in accounts receivable quickly enough. Maybe we're not paying because we don't have the cash, our payables off, and cash and cash equivalents decreasing, getting lower. This is a major problem, and companies that overtrade, to use the word, can go out of business. They need to be careful. Again, we get back to that whole area of cash is king. Having cash available to pay your debts is absolutely king. Okay, so this concludes the chapter. Let's do a quick summary here. I'll re-emphasize just one or 2 points. The first one is that this is a great practical chapter for you, and indeed, obviously, these questions are going to appear in the exam. Memorize the formulas, absolutely. And indeed, look, when you're doing the questions, the OT questions and watching the videos, be very, very careful to dwell on reasons behind changes. This is where very good learning takes place, and I think this is where many of the questions will actually target. Okay, I hope this last chapter has been helpful and that your studies are going well and that you're well advanced in terms of covering OT questions on other chapters as well, and you soon will be on this chapter. Many thanks for listening.